Welcome back to the Singapore Trading Festival 2022. We hope you had a pleasant lunch break, and a quick reminder that the views shared in this event are in the personal and professional capacities of our speakers. And also, folks, we have a great exhibition area you don't want to miss out on. So let's take a quick tour. What you do is you click on the bottom left corner. You can see there it says exhibition. So click on that. And then you'll be able to see all the exhibitors with their virtual booths. But there's more. So click on the right button and you'll see there's actually a whole lot of exhibitors that aren't on that first page. So don't miss out on any of them. So if you click on one of them, you'll head into this area, which looks like a virtual representation of what their actual physical booth would be. Very futuristic. And you'll be able to click on a variety of things. You can click on their reception booth. You can click on their brochures to see the offers they have and the information they have lined up for you. If you want to send in any questions, you can click on inquiry to send in questions via their form. Or if you'd like to speak to one of their representatives live, you click on the picture of the lady on the right for live chat. And you will be able to speak live to someone who will be able to answer your questions. So it's really great. Don't miss out on that. Do check out the exhibition booths after this session. Now, we have got 4 great sessions lined up for you this afternoon, starting with Mr. Tim Phillips, the head of content and investment lead at ProsperUs, who's looking to answer a very pertinent question for all our viewers. Are Singapore REITs ready for rising interest rates? Tim, are they really ready?
I think they are, yeah. So I'll show everybody over the next sort of course of 30 minutes, 40 minutes, what my views are and how I see it panning out. Okay, so let me just start by sharing my my screen. I'm gonna launch into it and kind of take everyone through this relatively quickly, hopefully, so I can leave more time for questions, because I think that would be probably to the benefit of you guys in the audience, rather than me sort of going a bit crazy on the deck. So I'm probably going to speak for about maybe 20 minutes, half an hour, and then we can leave some time for Q&A. Okay, so I think this is a big question that everyone's been asking, right? Is are REITs ready for rising interest rates? The conventional wisdom is, if interest rates are rising, then REITs obviously take on debt, and debt costs will go up. Ergo, share prices will go down, or unit prices will go down. So that's the conventional wisdom. You want to therefore avoid REITs or not be invested in REITs sometimes during periods of rising interest rates. So I think I want to kind of explain where my thinking is on that and how I see it. So first off, the disclaimer, obviously, everything I took it changing first off, right? I think we saw the pandemic really decimate, obviously, retail because of footfall and things closing down. Commercial was obviously also taken down a peg because of people staying at home, working from home. And obviously, we all know how logistics and industrial held up, and data centers, just because they are essential services, they held up relatively better, right? But we're kind of seeing the corner being turned in terms of commercial rents, in terms of retail rents, and obviously with the recent opening up announced by PM Lee, I think there's a bit more confidence and a bit more maybe optimism in the REIT market for these names that have been beaten down quite badly. But I would say, obviously business as usual is not going to return. So I think we need to get used to a post-pandemic economy, and how does that look? So at this point in time, I think there are some trends that will probably continue to continue, which were pre-pandemic. So on the left, you can see how CBD grade A and B rents in terms of office space is likely to pan out over the next couple quarters, couple years. And you see with grade A offices, there's always been that premium. And I think that premium is likely to widen over the next few years, just because there's not going to be, maybe there won't be as much demand for space in the office, but there's always going to be some people returning to the office, whether it's a hybrid model, and whether people actually need to be in the office physically. There'll always be some people who need to be in. the office physically, and obviously the grade A office space, I think, will always have that demand just because it's of that quality. So I think that premium and that gap between grade A and grade B will probably continue to widen. Over on the retail side, though, obviously it looks a little bit different. So this takes a look at 2010, what was the retail trade mix, and then versus 2020, which obviously we can kind of see the differences are quite stark, right? So obviously you're looking at department stores closing down and that kind of news really feeding through into the retail trade mix generally with retail REITs. And I think it's a much more experiential sort of I guess proposition from the REIT sense, because now they need people to come in, they need people to sit down. F&B is becoming a much more critical part of their offering rather than stores. I mean, the rise of e-commerce, if you think about just IT and things you can buy online from, say, Amazon or from wherever, Lazada or Shopee, you don't actually need to go into the store to buy that. That's not really a trip that you're willing to make maybe to the shopping mall. So I think it's become a much more social sort of arena for people to go out, to experience things, to eat, obviously maybe to do rock climbing indoors or something. So I think Funan with Capital Land, they have that idea of it being much more experiential and much more IT focused. So I think there's a reimagining of how retail works. And so at this point in time, it's not really certain how that's going to pan out for retail REITs and how the recovery is going to look. So I think it's still a lot of uncertainty on the retail side, more so than on the office side, on the commercial side. I think something I want to address is inflation, because I think inflation obviously ties into interest rates. The Fed thinks about how high inflation has gotten, 7-8% in the US, and how much they need to tighten, how much they need to hike rates. And that's obviously going to play into the decision making on the FOMC. So if we think about Asia from an inflation perspective, we don't really talk that much about how benign inflation actually is in Asia. So even though all the news headlines are talking about gas prices in Europe being at whatever multi-decade highs, oil prices hitting highs since 2008 or since 2000, there's not really that much talk about inflation in Asia. So there's a good reason for that. I think it's mainly because for at least commodities in Asia right now, rice, which is the big commodity that we consume in Asia, has actually fallen over the past year about 20%. Whereas obviously things like wheat, things like corn, those prices have gone up 70-80% because of Russia's position and Ukraine's position in obviously wheat and other commodities that are important for maybe basic staples in Europe as well as the US. Whereas in Asia, rice, we have there's a massive supply of rice. So rice prices have actually come down, and they play a big part in food inflation in Asia. And so that's been a reason why inflation is pretty benign here. Same with China, with pork in China, pork prices have come down in China. So that's helped inflation in China, which is obviously a key economy within the region. And supply disruptions, they haven't been as bad. So these charts are from the ADB, Asian Development Bank. We've kind of seen, this is at the end of 2021. So I think in Asia as a whole, there will still be inflation. There's still going to be fuel, obviously energy prices are going up, and that's going to hit everybody. That's not just going to hit Europe and the US. But I think from the food inflation perspective and from a relative perspective, Asia is in a much better position inflationary wise versus the US and Europe, obviously with all the pressures that they have, with Europe relying on Russian oil and gas, and with the US with the stimulus that they've had and with inflation hitting sort of 8%. So there's a lot more pressure on authorities and governments in Europe and the US to really tame inflation, much more so than here in Asia. So that's something that we should keep in mind. Okay, so can REITs handle the interest rate heat? That's something that we should obviously talk about and really study over the next sort of 20, 30 minutes. I'm going to try and cover this as efficiently as I can. So rates going up, I don't think that equals underperformance. And so we can kind of see from the last Fed tightening cycle from sort of maybe early 2016 to the end of 2018, that REITs actually did okay. REITs actually performed pretty well. Obviously, interest rates were coming off basically zero, and inflation was benign. So that's another thing that we have to keep in mind. That inflation was benign. So that's something that we should obviously consider. Is inflation today is a lot more different to inflation in the last Fed tightening cycle. But having said that, we don't really have the data going back because inflation really on a global scale hasn't really been that bad for 20 years, right? And so I think the earliest REITs that were being listed were in early 2000s. So we didn't really have the data from the Singapore perspective. But if you think about the total returns of obviously the ST-REIT index, FTSE REIT index, as well as the iEdge S-REIT is really easily outperformed the Straits Times, right? Total return index. Obviously, the Straits Times catching up a little bit, I think, from this year, given sort of banks and oil and gas in Singapore. But on the whole, the REITs sector in Singapore did really well during the whole Fed tightening cycle about sort of 5 years ago. So if I think about data for REITs as a whole going back, I think the best one to use is the US, just because it's the biggest REIT market in the world. It's also got the historical data since REITs started being listed in the US in maybe the sort of 60s, 70s. So it's a pretty old asset class for REITs. It's the original sort of founding market of REITs. So if we think about REITs as a function of inflation, or how we can hedge inflation rather, I think it really actually works a lot better than what you would consider the typical inflation hedges. So you think about gold, obviously commodities, and I think I do see the point about commodities being an inflation hedge this decade just because of what we're seeing in the market. But for me, commodity prices are always just a bit too volatile for understanding if you want to buy and hold. So I'm much more focused on where is the market going to be heading in the next 5 to 10 years. And trading stuff on REITs or trading on REITs is fine if that's your allocation. But if everyone has their long-term allocation, how they want to invest longer term, retirement, etc., then we have to think about where we're going to be positioned over 5, 10 years and obviously allocate accordingly. And so REITs are a really good hedge against inflation. So we don't really talk about it that much, but number one, they own physical assets. They own real assets. That's already a massive advantage in an inflationary environment. Number two, if they have quality assets, they also have pricing power, right? They have pricing power, which, as we all know, as Buffett says, if you have pricing power in an inflationary environment, that's going to be extremely beneficial to shareholders, or it should be. They should outperform. And number three, there's always going to be demand for property, no matter what form it is. Maybe it's being converted from commercial to other sorts of data centers. There's always going to be a demand for property. So it just depends on how it's utilized. So I think there are really good reasons why REITs, at least from the US perspective, have outperformed periods of high inflation in the past. And so I don't really see there being any reason why Singapore, with its REITs, total REIT sort of the portfolios of Singapore REITs now are really actually global. They're not really Singapore focused. You have some of the big ones like CapitaLand, the integrated commercial trust that are maybe 90% Singapore, but a lot of them are really international, right? They've got properties in the US, they've got data centers in the US, they've got offices in the US, they've got logistics properties in Australia and Europe and the UK. So they're actually really global nowadays. So I think it's a good proxy thinking about US REITs and where they sit, and thinking how do we extrapolate that to maybe this decade or the next sort of 5 years where inflation is going to be probably above trend, and how do we allocate, right? So I think that's something that we can maybe take a bit of solace from, is the historical data is pretty positive for REITs as a whole. Obviously, it's never going to play out exactly the same, but I think that's something that we should definitely at least just take note of. In terms of Singapore specifically, this is some data from our team, the research team in CGS-CIMB. If we think about S-REITs as a whole, they've actually done quite well in paring back, obviously, fixed debt, floating debt over the past sort of year, in light of what they obviously see, and everyone could see, that was going to be rising interest rates probably in this year and into next. So if you think about the debt profiles at S-REITs as a whole, Singapore REITs as a whole, it's pretty responsible. I don't think there's any real danger, of a blowout in terms of debt maturities or massive debt maturities coming due this year in 2000 or even next year, right? If you think about the left-hand side chart, there's only about 30% over the next 2 years, right? So a lot of it's past 2025. And if you think about fixing debt, a lot of S-REITs have pivoted and have started to fix a larger amount of their debt when rates were lower. So I think that's helped them also hedge against the risk of rising rates coming into this year and obviously into next year as well. I'd like to make the point with DPU sensitivity. This is a DPU sensitivity analysis by our team again at research. I think it always sits with smaller REITs, and that's something I've maybe always felt as well. When you do buy REITs, I'm much more attuned, or I'm much more biased towards the larger REITs, the larger cap REITs, obviously for liquidity purposes first, but also because of spending power. And I think it insulates them even more now with rising rates, cost of debt, gearing, obviously, et cetera, et cetera. But the DPU sensitivity is definitely more focused with the smaller REITs, the smaller cap REITs. And you can kind of see with hospitality, there's obviously an opportunity for those types of REITs to really do well in this year and next, because obviously travel's opening up. So that's positive, but there's also uncertainties as to the extent that Singapore opens up or the pace it opens up, right? And then what happens if there's another variant, et cetera. It's too much uncertainty for my liking. I still like industrial. I think it's just got all the right structural headwinds. It has the strongest balance sheets. It also has the least, probably among the least sensitivity to rising rates. Office and retail, where do they go next? I think office is positive. It looks like it's a positive outlook for this year. Retail, there's still question marks in Singapore about leases, also about rental reversions. And then healthcare is the super defensive, classic, Parkway Life REIT. First REIT less so because of their disastrous, I think, past 2 years. But Parkway Life is always traded at a premium, right? Just because healthcare is super, super defensive. And so I think when you think about the stock market as a whole, healthcare is always a defensive sector. And then if you translate that into the REIT sector, it becomes, doubly defensive, just because healthcare properties, they've got a lot of nursing homes in Japan. They've got, massive multi-year leases here with the Parkway Life Hospital. So I think it makes it a lot more visible, their income stream, but obviously you take a lower yield for that. So that's something to think about. I do want to mention about growth. Growth does need to be present. Again, that's why I think with the larger REITs, they've got a lot more firepower. They've got a lot more AEIs that they're putting into, proposing to shareholders, to unitholders to hopefully squeeze out more income from the assets that they currently have. And more REITs are venturing overseas, right? They've got the leverage to do it with the recent sort of the past few years where they raised the cap at the MAS to 50% from 45%. I don't think many REITs will probably go even close to 50% just because of that uncertainty with rates. But it's good to know that they have that leeway if they need, and there's a bit more headroom, in terms of the actual total ceiling. And you saw this is a chart that, Bloomberg's obviously displayed before, but the deal value last year was a record high. Deal count was a record high. We've seen some really big blockbuster mergers. We saw that with Mapletree Commercial, Mapletree North Asia Commercial Trust, just because size matters, right? It's the biggest, the baddest with REITs in terms of debt servicing, in terms of firepower to acquire. And so it was no coincidence for me, at least, to see that these deals were record highs last year, just because they were beefing up before rates started to hike this year. And so I think it's been pretty prescient of the REIT management. I think it's been pretty responsible. And so I think the outlook is, for the environment we find ourselves in, at least, is pretty bright. So how do you position your REIT portfolio for this type of environment with rising rates, with obviously war in Ukraine, with inflation? I always say go focus on just the key metrics, right? Nothing really changes for me from a perspective of what is this REIT offering you on a longer term perspective, and have they been consistent, right? So this is something, go check out our website, prosperus.asia, but these are a couple of articles I'll share that I've written just on key metrics that I focus on. Strong sponsor, I think, gets overlooked a lot, just because, there's a lot of attraction to the higher yielding REITs and maybe the rebound REITs, because they've come off such, they're hitting lows, they bottomed, so maybe there's a chance to trade it, which I think is, if that is your time horizon, if it's 3 months or 6 months, that's up to you. But I think there's always a space for for everybody actually, who has that long-term allocation. So I'm talking about the long-term allocation here. How do you think about REITs from a perspective of holding for retirement or investing over 5, 10, 15, 20 years? And so these are 5 really, really important factors for me: diversification, Strong sponsor, obviously manageable or lower gearing ratio is preferable coming into this environment, at least. Consistent DPU, right? There's no point if the DPU is hiked. We saw a lot of headlines in the past couple months with earnings of, oh yeah, DPU's is up 20-30% and year on year, which is great. And then you obviously go back to 2020 and some of these retail REITs had cut their DPUs by like 60 or 70%. So there's no consistency there. If there's a lot of choppiness in terms of the DPU, there's no reliability to hold it as an income investment, right? If you're thinking about retirement or if you're relying on that income, I really try and figure out where the best REITs in terms of their DPU track record, in terms of their consistency, in terms of their payout, and really focus on that. And then obviously, finally, you want a long weighted average debt maturity just because you want that debt management to be secure in this kind of environment. And just generally, I think it's good practice. Other factors to look out for, obviously the usual, longer WALEs are better because it gives you more income visibility. You don't want so much property concentration. That's one thing why I think Mapletree North Asia traded at a discount, right? It's just got such a massive concentration in Hong Kong, and it's particularly Festival Walk, which I think made up something like 60 to 70% of its gross rental income. It's just way too much, right? So if you're thinking about REITs from a size perspective, you want the property concentration or the customer, tenant concentration to be less than 10% ideally. That's probably what you'd be hoping for. Interest cover ratio, I think a lot of the REITs now are pretty solid on that front. And weighted average interest rate, cost of debt is always going to be low with the bigger REITs just because of the size. And obviously, because they're global now, you always want to think about Forex and the risk management. Are they hedging that debt in US dollars or in euros or in whatever currency, in Australian dollars? Are they managing that risk from the Forex perspective? Okay, that it's not going to impact DPU or income in the future. And so check out the article again, why I think, bigger is better. I think this was actually written about a year ago, but it's totally still applicable today. It's really even more applicable today, I think, with rising rates, with what's happening with liquidity in the market, especially in Singapore, with the bigger REITs really dominating that liquidity. And so I think the price action and the ability to purchase and to raise DPUs are just going to be bigger and better with the larger cap REITs. This is something that I didn't have time to get my research team to run the data as of the end of March, but I mean, it's kind of more of an illustrative point anyway. Just thinking about total returns versus price returns versus yield. So think about the total return when you do invest in a REIT. Think about where the structural decliners are, avoid them, understand where the structural winners are. And I think there's always going to be that discussion about, Mapletree Industrial and Logistics trade at a premium because the price to NAV or price to book is just way more expensive than some of these other REITs like Capital Land Integrated Trust or Commercial Trust or Mapletree North Asia Commercial. And so I think it's more about paying up for the quality as long as it's not outrageously expensive. And I think on the perspective of from a time horizon, thinking about total returns, and there's a pattern, right? So I think when you look at maybe fund managers, they always say, don't focus on, historical returns are no indication of future returns, et cetera, et cetera. And that's a disclaimer. I mean, I worked at Schroeder, so always have to have the disclaimer. And I think that's true in the fund manager sense, because fund managers, they're picking stocks, and if they leave or if they have a cold streak or bad streak, they underperform the market. And so that's true. But I think when we think about stocks, I definitely adhere to the Motley Fool, David Gardner type of mentality where winners win, right? Winners continue to win because management's doing something right. They've got either the best assets, the best management, the best approach. They're in the right sector, and unless that really drastically changes, there's really no reason to think that otherwise, there's going to be a massive surge in price from maybe the retail or the office REITs, and they're going to really outperform for the next decade. So unless you start to see that play out over 3 to 5 years, obviously over the past year, there's been a bit more outperformance on the retail and the commercial REIT just because of reopening. So I think that's understandable. But once that normalizes and we get back we've settled into a post-pandemic lifestyle and economy, I'm really curious to see, will that outperformance continue, or will, the industrial REITs, the ones that have really outperformed in green here, will they just continue to outperform, right? Because if you go back 10 years, 5 years, 3 years, they've really just easily outperformed. And so I just really I really think it's more about honing on the winners, really focusing on what works. And if that does work, and if management are proving that to unit holders with consistent DPU increases, with the share price appreciation, with the total return being positive, and outperforming the Straits Time Index or the ST-REIT index, then I think there's really no reason to think that you should be going into some other, having massive amounts of your capital go into other REITs. So I think it's more about staying focused on that and thinking about it from a longer term perspective, and just going back and looking at the results. What have they done? How is the share price appreciation done? How is the DPU done on a 3-5 year basis? What's the CAGR of that DPU? Has it grown consistently? Are acquisitions going to be DPU accretive, and at what percentage, right? Is it like going to be 0.8%, 1%, or some of these bigger REITs are acquiring and they're seeing some pretty good DPU accretion of maybe 3 to 4%, right? So I think there's a whole array of factors that should go into figuring that out. But at the end of the day, for me, winners do win. And so I think that's likely to continue. I don't really see that changing. Okay, so finally, so how's the REIT market really transitioning and changing in this new world? Willem Dafoe there is a bit creepy, but it's like people want to buy real estate, right? Yeah, everyone wants to buy real estate. I think REITs offer the best way to have access to it because it's obviously low cost. You can buy a portion of it. You don't have to manage it. I mean, everyone knows the benefits. But for me, looking to other areas, I'm always curious about where the next growth opportunities are, where the next structural growth stories are. This is a headline from The Economist, which is just talking about science and technology, right? In sort of reinvesting in the US. So there are lots of REITs now, or there are more specific REITs in the US that focus just on sort of life sciences, healthcare properties, because obviously these properties need to be fitted out with specific equipment. They need things to be at certain temperatures. They obviously need safety, health and safety requirements as well. So there's a lot of specialized property that's being built for the likes of Moderna or the likes of Pfizer, et cetera, right? And so these also provide an opportunity for REITs to really expand into that area. In Asia, it's still quite nascent. It's still quite a young industry. So I think, the amount of space available is growing, but it's not significant at this point for REITs. But I think it will be in sort of 3 to 5 years. And I think it's an area where the first mover is going to be important, right? You want to specialize in that, and then you start getting momentum and start leasing to more of these big farmers. And obviously, Singapore as a hub in Asia has really positioned itself in life sciences, in healthcare. And so a lot of the large farmers have Asia headquarters in Singapore. And undoubtedly, I'm sure they're going to start producing things here in Singapore, whether it's vaccines or medicines or medical equipment. So I think there's going to be opportunities for Singapore REITs to really focus on that sector. And it's an exciting sector. And I think that's going to be something that's going to play out over the next 5-10 years. And so it's definitely something to watch. But as I said earlier, at the end of the day, property income streams, they're almost undisruptible from that sense that physical real assets are going to be really important this decade with inflation. And they're going to provide that income. It's just dependent on from where the opportunities are going to be. So I'll leave it there. I'll stop the slideshow now, and I'll kind of take some questions from Slido if anyone wants to shoot something over.
Quite a few questions for you, actually, Tim, on Slido.
Okay, great.
I'm just going to jump in here and help you out with them.
Sure. Should I stop sharing my screen? I don't know if you want to share the questions on the screen or.
It's okay. You can stop. You can just leave it as it is for now.
Okay. Right. Yeah. Cool.
And they'll switch us back. And so, most upvoted question, folks. There is a box on the right. We've been referring to as Slido. That's actually where you enter the Q&A. So just go to the box on the right and enter your questions, and also vote. You can scroll down and vote for the ones which you want answered the most. So Tim, first one, you've already alluded to this. An interested investor is asking which type of REITs will outperform this year.
This year, okay. Well, I mean, I'm typically a long-term investor, but I think this year, from my perspective, if I'm just thinking about this year, I think I agree with some of the analysts from my team at CGS-CIMB. I think the retail and office space with reopening, right? That's just natural. I think they will. I mean, hospitality, if travel opens up, that's obviously another one that I think will outperform. I'm just a less sure on hospitality just because of the reopening pace and how that's going to go. I know the government here is a bit more cautious, so then but things have fallen away quite quickly, I think, in terms of the restrictions. It's just what happens if there's another sort of event or there's another variant, etc. So I think hospitality is less of maybe a sure thing, but I think office and retail are the obvious ones, right? I think that's just because opening up, people going back to the office, people going back and eating out and shopping. So I think that those are the natural ones that you would just gravitate towards.
I think we've discovered, especially here in Singapore, that retail is an essential profession.
Yeah, it is. I mean, I'm not sure, but I think Fraser's Centrepoint has probably outperformed just because it's more essential than something like a CapitaLand integrated, just because their malls are more in the CBD, and obviously with Fraser's, it's more in the heartland and like in the suburbs and further out, and those are really essential. So I think Fraser Centrepoint has been one of the really strong ones from the retail segment.
Yeah, there's a good note there about suburban malls, folks. So if you're looking at retail, also look at where the malls are located. Yeah. Next question. So this is from FH Tan. Your views, Tim, on pure data center REITs?
Yeah, so I think Keppel has traded at a really big premium, Keppel DC, and obviously that's come down a lot. And I think they've underperformed quite a lot over the past sort of 6 months, maybe 12 months.
Quite a rough year for them.
Yeah, I think pure DC, it's not obviously digital core REIT just IPO'd. I actually think they've got a better pipeline than maybe Keppel DC because they're focused more in the US and the demand there. And then also they're backed by Digital Realty, which is just one of the biggest data center REITs in the world, right? So I think the sponsor there is just really premium experience in that space. They know it really well. In terms of the moratorium here, I think that lifted recently in Singapore. So there's going to be more space opening up for DC here. So I think there's going to be more opportunity. The pure data center REITs will continue to trade at a premium just because there are lots of people that really love that space, but I would definitely be selective. My preference is Mapletree Industrial. I really love how they pivoted. They still have a lot of industrial properties in Singapore, but they've got a massive portfolio in the US. And they've got an aim to sort of shift about 60 to 70% of their portfolio to DCs, right? And they've struck up really interesting partnerships with some of the big data center REITs in the US. So they've got that experience as well, but they've also got that industrial proportion and that they're trying to refashion and obviously get more income out of. So I would that would be my favorite DC play.
And I think there's also the possibility of the fact that there's a lot of, with the rise of crypto, there's a lot of Bitcoin miners that have moved to the US.
Yeah, because it's actually because I think with China banning Bitcoin and that whole mining fiasco, there's just a lot less there's a lot less certainty in China, right, with crypto mining. And I think with the government in there, it's so opaque, you don't know what's going to happen. So I think a lot of people have moved to the US. There's a lot more data center demand. The cloud industry there generally is just so huge in the US, and there's always that demand. I think the worry is everyone is super bullish on it, and it's a really great industry, but then you have to watch for supply, oversupply, watch how leasing demand changes, and also, rental reversions. What are management teams saying about that? Because the automatic reaction is just to go in and it's a great sector. It's really good, but there's going to be obviously variations from a regional perspective in the US for demand and for space availability. So definitely keep an eye on the markets regionally in the US, because it's a big landscape in the US in terms of where DCs are located.
Yeah, and even in the crypto industry itself, because the second largest coin by market cap is switching from proof of work, which is where all they do the mining, to proof of stake.
Right, yeah.
They're not mining, they don't do the mining anymore. So all the miners for that have moved to an earlier version of that coin, which is Ethereum. And the fact that that's a thing, that's possible, investors have to keep an eye on that.
Definitely.
Their mining might not exist tomorrow.
Yeah, no, exactly. No, that's definitely something to keep an eye out for as well, because I think everything in the tech sector is obviously going to affect demand and impact demand for data centers, whether that's, hybrid cloud or, on-site cloud computing resources or how the cloud works. It's going to be a really changing landscape, and that's going to impact DC demand as well. So I think that's something to watch. But DCs are here to stay, obviously. But you just have to be do your due diligence about each REIT that you buy into.
And speaking about due diligence, here's a great question: buy REITs selectively, as in choose your own REITs, or just buy an ETF? Which one?
I mean, I really love ETFs. For people who aren't bothered to really go into the research and do it, I totally understand. A lot of people don't have time. And so I think REIT ETFs are perfectly fine. Like, they can do the job. That's great. I prefer personally to pick my own REITs to really focus on what's worked. And I do obviously monitor them. I don't spend as much time as I might on other companies in my portfolio, just because I think they're so stable, and the ones that I own have continued to perform. And you do have to obviously commit time to understanding new deals if they're announced, or to understanding earnings and making sure everything's in order. So I prefer to focus and narrow it down, because I like to think about the DPU and that to grow. And I mean, two reasons why I hold Mapletree Industrial one reason why I hold Mapletree Industrial and Logistics is they pay out quarterly. They're both great REITs, but they also pay out quarterly, and that's not something that's very common in Singapore REITs. That used to be. A lot of REITs now are changing into half year, but I prefer to get my dividends and then reinvest them. So if you get it 4 times a year instead of 2, I feel like you're reinvesting it a lot more frequently. So to me, that just makes much more sense than getting it twice a year. I know it's the same thing, but I prefer to get things 4 times a year and then reinvest it and let that compound faster than doing it twice a year. So those are some things to think about. But I think if you don't have the time and you're not really interested, and I think a REIT ETF is a great thing.
0.75%, right?
Huh? Pardon?
Just pay the 0.75%.
Yeah, just pay that fee. I mean, it's fine.
Do it for you.
Because you can't compare it to sort of a Vanguard, which is 0.03. I mean, some of them are like basically free, but I think for an ETF here in Singapore, that's pretty okay.
Yeah, it's not like, I mean, for reference, a unit trust usually 1.5%.
Yeah. So it's double, right? And if you're just thinking of income and you just want to put it in every month and not think about it, and think, and just track the index, then I think that's a good idea.
Yeah. So I think the answer, folks, is how much your own research and homework do you want to do?
Yeah, how bothered are you? That's the key. That's the question. That's the bottom line.
Thanks for that, Tim. Okay, so next question, actually from me.
Okay. All right.
This one's an interesting one, because literally there are 2 healthcare REITs.
Right.
It's Parkway
on
one end, and then First REIT on the other end, and there's a wide gap between the 2 of them. So I'm asking, does this mean that Parkway REIT has a moat?
I think Parkway REIT is I think it trades at a premium because it's based here, and it doesn't have all these web of shareholders and legacy issues that maybe First REIT has with an Indonesian, parent shareholder, and a lot of connected party transactions, which to me as a minority shareholder, it just doesn't feel that good, or it feels as though you should be a bit worried, maybe from a minority shareholder perspective. And really, Parkway Life REIT really they've never really made shareholders feel like that, right? It's been pretty consistent. DPU increases. They have 2 master leases here or 3 master leases here with the hospitals here, like Glen Eagles, and I think the 2 the Mount E Orchard, and I think they have the right of first refusal for Mount E Novena. Mm-hmm. And then they've just signed new 25-year leases with those 2, and then they've got a massive portfolio in Japan, right, of nursing homes, and in Malaysia. So I think from the transparency and just understanding that the REIT side of business is just a lot more straightforward with Parkway Life. And they've outperformed. You've seen again the returns that they've got. They traded at a premium. I mean, it is quite outrageous. I think it's like 2.3x price to NAV. So it's a lot more expensive than any logistics or industrial REITs out there. But it's been super stable. It's defensive, but it's low yielding as well. I think it yields like 2.5 or 6%. So it's one of them that it's low. So if you really, really are worried that the world is just, I don't know, going down the drain, then maybe that's the REIT that you want to buy. I think that's the one that's just like, okay, that's the healthcare in Asia. There's always that demand. There will always be, nursing homes in Japan. There'll always be Singapore as a really great healthcare center in Southeast Asia, and people will always be paying for healthcare, right? So I think that's the reason, and they've managed that portfolio really responsibly and well.
We've got an aging population. which is a real it's a real issue, and that taps directly into that.
Yeah, I think that's something that a lot of developing, I mean, Singapore obviously now develops, but Korea is the same. And obviously China, we all know about the demographic issues that China has with an aging population. So I think Asia as a whole is definitely aging fast. I mean, one of the younger nations would be India, but besides India, I think the majority of North Asia, and then at least Singapore, is definitely aging faster. So there's going to be that demand for sure.
Okay, so Parkway REITs, folks, it's the one REIT that I told my wife, just buy it.
Yeah.
Losing money. And she will it lose money? And I was confident to say no. It will be fine.
Yeah.
Okay, next question. So this is from Karandash. That's as a foreign investor, would you recommend building S-Reits into their retirement portfolio for a sustainable passive income and to hedge against inflation, and also to diversify to include exposure to SGD?
Yeah, no, definitely. I think a lot of these, I really try to encourage, I mean, I'm from Hong Kong, so I have friends in Hong Kong who invest, and obviously try to get them to think about Singapore REITs as well, just because I didn't really discover Singapore REITs until I came down to Singapore in 2015. And then I, was working with the team down here at Schroders and talking to the team and understanding the REIT landscape. And it's really come on, I think, in the past decade. And obviously since the early days when stuff listed in 2002, 3, you've really seen it become a REIT hub rather in Asia. I think it's the biggest outside sort of Japan, right? Japan might be the biggest market for REIT. But I think it's definitely something that global investors should think about, because as I alluded to earlier in the presentation, Singapore REITs are now actually global. I mean, whereas maybe in 2010, 11, 12, it was very Singaporean, the REIT landscape in terms of the assets they hold. Whereas now it's totally global, actually. I mean, they have obviously the Singapore portion of their portfolio, which might make up 20, 30, 40, whatever, 50%. But there's definitely a significant portion of the NAV and the asset value of the portfolio in overseas properties, just because these guys are so big, they've gotten too big for Singapore, right? They have to go overseas and buy and acquire to keep growing. And they've done that, and they've done that really, really well. I think they've executed on the whole quite well. The big REITs have done it really well. I would add, I think from a foreign investor perspective, that obviously if you're a resident in Singapore, there's no dividend withholding tax. It's completely, there's zero, so you get everything. But I think if you're a foreign resident, my understanding, I think, is 10% on Singapore REITs, but I think Singapore stocks are 0%. So obviously double check that, but that's what I had gotten from an S&P withholding rates table. So it seems like Singapore REITs for foreign residents, I think it's 10% withholding for S-Reits. Yeah, so something to think about if you're outside Singapore.
Well, my friends from overseas are constantly amazed at the fact that Singapore is a tax haven.
Yeah.
You have no capital gains tax now.
Yeah.
You get all your dividends. Yeah.
Yeah.
Amazing. For Singaporeans, if you're watching this, you are very blessed. Be grateful. You don't know how nonsensically hard it is to do your taxes overseas if you're an investor.
Definitely.
All right. Next question. So this one is from I think this is a great question from Interested Investor again.
Yeah.
What level of interest rates does Jerome Powell have to hike to for us to start worrying?
To start worrying? Okay. I mean, I think they hiked last time to about 2.5%. I think it's less about the level rather than the pace, right? And whether in terms of how they forecast the rate hikes, when they talk about the dot line in terms of rate hikes, the FOMC always kind of give guidance on where they see rates going. They really speeded that up, or they really hiked the dot line kind of accelerated over the past sort of few months, because they'd obviously thought, okay, we can just do like 2-3 rate hikes this year, and obviously that accelerated to 6 or 7. So now that's been priced in. We've seen the markets come back and obviously pull back. That's being priced in now. I think, the level could be subjective, but I think it's more about the pace of it, right? And for the FOMC at this point, it's more about how do they manage the pace of rate hikes versus the the economy, the US economy, and making sure the US economy doesn't tip into recession, right? So the tightening pace and how they manage that is much more important, I think, than phenomenal value of the rate, the interest rate level, because it's much more important to the US economy, which then has knock-on effects for the global economy, how fast they tighten. And there's a lot of worries in the financial community about how fast, how do they manage that dilemma of tightening, bringing down inflation without putting the US economy into a recession or tipping it into a recession. So I think that's the key thing to watch, because if there is a recession, then that's going to be bad news. And, if you have a recession paired with rising rates, that's going to be, it's going to be continue to be painful, but hopefully inflation will come down. So I think that's maybe more of the key, because if you think about Singapore REITs last year hedging a lot of their debt and then going back into fixed rates, I think they foresaw rates obviously hiking this year, and they were maybe more conservative, which is what you want, right? I think you want them to be more conservative, and it's panned out pretty well, because now they're pricing in 6 or 7. So it's going to rise quite quickly this year. Into next year, let's see what happens. But I think, as I said, it's much more important to focus on the projections of the Fed and where they see it going. And if they accelerate it, then it's something to maybe worry about.
Is there something to be said, though, Tim, about the fact that you hike the interest rates to slow down the economy, right?
Yeah.
The economy is overheating a bit, but we've got geopolitical tensions. We've got energy prices going absolutely through the ceiling.
Yeah.
That's going to do a lot of the job for us. The supply chain issues are going to continue indefinitely. We don't see an end to that.
Yeah.
The supply chain issues. Might it mean that we might be surprised sometime in the near future to see as we inch closer to major elections in the US, that the Fed may go, hey, I think we're done early.
Yeah, that's the upside surprise, right? I mean, so there's always that one. I mean, now that we're all talking about rate hikes, no one's really thinking, oh, what's the upside surprise from actually them on hold, right? Holding rates. I mean, everyone's talking about it in the analyst community and everything. All the commentators saying they don't envy the Fed because they've got like crazy energy prices, inflation, overheating economy, really tight labor market. Prices are rising from everything from commodities and food to oil and gas. So it's really difficult environment to start to tighten, as well as obviously a tight labor market. So that's not usually what you'd have with sort of inflation at these highs. So it's a difficult environment for them to really tighten. And that whole transitory inflation is transitory thing that the Fed was.
We heard that last year.
Yeah, we're spoon feeding markets. That's obviously not played out, and so now you really have to think about the Fed's credibility and where they stand on inflation, and are they willing to, like where is their priority, right? Holding down inflation or making sure the U.S. economy and the labor market is robust and healthy. So that balance of where they see their priority, are they going to do anything they can to take inflation down by raising rates? Like at this point, still not clear, because we've only seen, maybe 6-7% inflation for maybe 3-4 months. So I think the further it goes, inflation, I think inflation this month, it should be well over 8%, I think. So I think that's going to be something that they're going to have to consider. And they're talking about 50% basis rate hike, 50-point rate hike next meeting, I think either in May or June. So that's something that that could pull back prices. But a lot of the price action is really difficult to really control, right? Because it's coming out of Russia and Ukraine with oil and gas. In the US consumer is really flush with cash from stimulus checks. That could taper off. But if wages keep growing, right, then there's issues with the whole wage inflation price spiral. So I think the Fed has a lot on its plate, but I think the Singapore REITs are doing really well right now in managing that. But the level, I think the level is not as important as where they're headed, because that's much more important.
Thanks for that answer. Next question for you, Tim, is a bit closer to home for you. John Toe asking your view of CapitaLand China Trust, CLCT.
I think for me, I'm much less bullish on China focused trusts generally because of, I mean, we're seeing what's playing out with the coronavirus. And I actually think that's one of the big threats I mentioned on a outlook at the beginning of this year is how is this COVID thing, the zero COVID policy going to really play out in China, and what's really going to tip the scales in terms of getting, the Chinese Communist Party to really say, okay, we can't let the economy slow down this much. We're going to have to live with COVID, with COVID in some form for growth to be at 4 or 5%, right? So because of the decision-making process, it's really difficult to understand where they stand on that issue. And so for that reason, there's always a lot of stop-start. And we kind of experienced that in Singapore last year, right? Because there was that whole debate about living with it, not living with it, and then variants. And so I think most of the world now has come to that conclusion with Omicron, at least, that this variant is something we can live with. And we're seeing that with Singapore opening up. But in China's case, I think that's what really held a lot of retail REITs back last year, was just this stop-start. You don't know what's happening. And then that's just a function of uncertainty and not knowing. And obviously that impacts the consumer, that impacts the economy. And so you think about that on the Singapore scale and then times that by, like 1,000 or 10,000 in China. It's a bit like, I don't know if I'm confident until I see some sort of plan or game plan in China that this is going to be living with COVID and understanding, that the economy can function without being shut down at sort of a moment's notice or a week's notice or 2 weeks notice. It's really difficult for me to have confidence that they're going to be, that those REITs are going to really rebound this year or do really well. And don't forget that in these lockdown situations, retail's the first thing to go, right? Retail's the first to suffer because people don't go to the shops. People aren't allowed to go in, or they're locked in their apartment buildings. And there's a lot.
I just want to say that there was this amazing story about the lady who was locked in her gym.
Oh, in like
locked down in her gym, and she had to stay there for almost a week, sleeping on gym mats.
Oh my goodness! Yeah, she could work out, I guess.
She lost 3 pounds at the end of the week.
Yeah,
working out nonstop.
So I mean, I think that's, and then I think it's more like Singapore's a microcosm of that in the beginning of the pandemic, because you saw with logistics like Mapletree Logistics, Ascendis Industrial, Mapletree Industrial, they all part of essential services, right? They're dealing with logistics, they're dealing with properties that are really essential to the economy. So they're going to stay open, and they're really going to be the last one to close or to really be hit. And so retail's just the first one, it's sort of the first one out of the trenches that they're going to get hit first. And it's really difficult to foresee what's going to happen if the Chinese economy, just slows down to whatever rate of growth, or they say there's going to be a shutdown in, 40-50% of the country. So I think there's just really no visibility. And for me, that's uncertainty. And then uncertainty, I think feeds into valuation and then feeds into the share price, right? And so I'm really not keen on that until there's more clarity. On the whole, I don't think it's really outperformed even pre-pandemic. I've not really been that impressed with it. To be honest, I don't know as much about the China trust as I do about the local trust, about CapitaLand Integrated. But from the China perspective, from their CapitaLand China trust, I don't think I've been that impressed with the returns and with the DPU increases, right? I like that consistency in DPU, and it hasn't really been delivered. And so you add the COVID uncertainty in China into the mix. I think it's just, not one I would be interested in.
I think there was a question earlier about maybe they took it off, but I do want to ask you this big brain play idea.
Yeah.
If interest rates are going up, why don't we increase our gearing ratio now? Let's take a front run, borrow the money now, and then invest later before the rates go up.
I mean, I think a lot of REITs have actually already taken. There were some pretty big. I mean, as I illustrated, there have been some pretty big deals last year, right? So I think to take on more and really get close to that 50% cap in today's environment with uncertainty on the pace of acceleration, I think would just be irresponsible. So I think I'm happy as a shareholder to see that they are being conservative with how they, with how they allocate, with how they manage their debt, with the leverage that they're taking on. Because don't forget, in this environment, there's so much uncertainty with consumers. And then obviously China is not just going to affect China. If that whole thing plays out with COVID and they have to shut down certain parts of the country, that's going to affect the global economy, right? Because China's just so big now. You talked about We talked about shutdowns in Shanghai, and then the ports. Ports get clogged up. That affects US ports. That affects end demand in the US. That affects the economy in the US. It affects economy in Europe. So China's really, really crucial to the global economy. So any uncertainty there and any shutdown or any sort of COVID-induced lockdown is really going to impact the whole consumer globally. And so that's going to be something that we all have to take into consideration, whether you own a DC REIT or a logistics REIT or a consumer REIT, a retail REIT in Singapore. It's all really going to impact us. So I think it's important that they be responsible in the leverage, and I think they have been. And I was glad to see that there was a lot of acquisition activity last year. There's some really smart acquisitions from the bigger REITs. And I think there's a period now maybe of wait and see. Like I don't think there's going to be some really blockbuster acquisitions and buys this year, just because of
also good that we don't have any of those ego REIT situations.
Yeah,
exactly. We don't want anything like that.
Yeah.
So next one for you, Tim. This is the Godzilla versus King Kong question.
Right.
What's your view? REITs, Mapletree Industrial?
I'm definitely a Mapletree Industrial. Yeah, I'm a fan of Mapletree Industrial. I've always thought their acquisition track record has just been really, really top notch. Their DPU growth, go back to look at the DPU growth, from 2011. Just take a look at how Ascendis has done versus Mapletree Industrial. Mapletree Industrial, I think, has outstripped it by a factor of 2 in terms of its CAGR, right, over 10 years. So add that all up in terms of its total return. That chart I showed about structural winners, you'd think Ascendis would be a structural winner, and it has done quite well, actually. It's done okay. But if you really compare it against Mapletree Industrial and then also logistics, it's really underperformed quite a lot. And I think a lot of it's to do with maybe the acquisitions that they've taken on in Ascendis. Some of them have just maybe not been as, I just don't think it's been executed as well. And, the track record, it's just not got that. It's not really got that, that maybe the structural thought process to it. I mean, I was just really impressed with maybe I'm obviously biased because I hold Mapletree Industrial, but in terms of how they pivoted, to DCs, it was like 2016 or 17, right? And so that was quite early in the DC journey for a lot of REITs. And obviously now Ascendis is coming into the game. I think they acquired some in Europe last year for just over $1 billion. But that's
really a lot later.
That's late, right? So I think that's just a bit late to the game. And a lot of some of the acquisitions from their perspective, the DPU accretion is just quite poor. I don't know. That's how I viewed it, because I used to hold Ascendis, actually, to be honest. I did hold it, but I just, as from a shareholder perspective, I just thought it was not performing up to my expectations, and the track record for acquisitions, I just wasn't that blown away by. And with Mapletree Industrial, they've always gone in partnered either with Mapletree Investments, the parent company. They've taken on a 50% with them in some DC markets. They've gotten that experience, I think. Then they've obviously got that pipeline for the 50% they can take off Mapletree's hands later. So they've always got that optionality. And I think they've really done well by going into the market, which they don't know, and working with the likes of Digital Realty and a couple of other the big REITs in the US with data centers in joint ventures. And I think that's really set them up, for the next sort of 5-10 years to really manage that portfolio well. And so I think from an execution perspective, a management perspective, a DPU track record perspective, and obviously a total return perspective, they've just really outdone Ascendis. And so for me, it's definitely a Mapletree Industrial on that front.
Awesome. Thank you, Tim. We have time for one final question. And this one, we talked about it briefly just now when we talked about first REIT. Indonesia. So valuations for Indonesia really low at the moment. Is it a good time to do some bottom fishing, or are we sticking our hands into piranha infested waters?
I think just get to I don't know. To be honest, I'm not a huge REIT fan, maybe from the Indonesia perspective. I think Lippo Mall's right, and then this first REIT, obviously, that has the parent that's involved.
And but I think are insane. The yields are just wow.
I think if you're looking at the yield, that's just I want to get in there, right? But again, think about the track record, right? So if something like Lippo Malls over the past 5 years, I think is, negative, maybe, or 3 years, it's definitely negative. Like, is that going to change, right? Like, are you seeing catalysts that are really going to change that? That's really going to turn it around? Does it have the firepower? Has it got liquidity as well in the stock price and in the stock in Singapore and on the exchange? Because I think liquidity is something that we definitely underestimate from a price action perspective, right? So the more liquidity you get in the stock, the bigger it is, the more turnover you get, the more price action you see as well in the price. And that obviously leads to ups and downs that are a lot more, positive or negative. But on the whole, it's generally positive if you have more liquidity. And so I think liquidity for this Indonesia names are probably something that you have to really think about as well. And yeah, the track record for me is just do structural, losers, are they going to be coming? I think Lippo Malls owns obviously retail malls in Indonesia, but are they under threat from sort of the likes of GoTo and Tokopedia and Grab or whatever that are doing things in e-commerce or delivery in Indonesia? It's such a fast emerging economy and such a fast changing landscape that I don't know maybe enough. I'm definitely by no means an expert in Indonesia. So I think about the track record. I think about the performance. How is it done? Is it doing well? Is there other catalysts that are really going to change that story? Or is it going to continue to languish, right? Because I think it's languished for like 3 or 5 years. So unless you really think that this is the bottom for the next 3 decades, I would definitely just be cautious.
Thanks for that, Tim. The laws of physics, right? The higher the yield, the higher the risk. The lower the yield,
yeah, exactly. That's true. That's a good general rule of thumb. So I like to look, if you're thinking you want to balance between yield and risk, I think sort of the 4 to 5% range is good. If you get down to the 2 to 3% with Parkway Life REIT, which is obviously super solid, but you're not super excited by the yield. I think there are some industrial REITs, there are some decent retail REITs, there are some decent office REITs in the 4 to 5.5 range. So I think for me, that's good, right? That's a good enough thing. And we talked about inflation in Asia, right? What you need now when you think about the yield plus the DPU growth, you need that to really beat inflation. So with inflation in Singapore at 4% in March or in February, that hurdle to get over that DPU is much lower than if you owned a REIT in the US where you're looking at 8-9% inflation, right? So you're thinking, what is the hurdle for DPU growth on an annual basis that I need to get over? That's, to me, is the key, because you want DPU growth to be above inflation, to stand still really, or to even just be, to be making money on your dividend.
And that is a great rule of thumb. And thank you so much, Tim, for all those words of wisdom. Plenty of alpha there, folks, for you. So once again, that's Mr. Tim Phillips, Head of Content and Investment Lead at ProsperUs. Thank you, Tim.
Thank you, Edward. Thanks, everybody.